Hi, everyone. I'm going to go ahead and get started this morning. First of all, thank you for being here. I've got a lot, as I normally do. I'm going to say, first of all, we had this idea of a town hall style. Ask folks to submit questions, and I do appreciate everyone doing that. I've got questions. I will hit all the questions, actually. And also take some questions at the end as well, too, for any that are left over after hearing what I am going to present a little bit today. I don't have quizzes for you because this is more town hall style, but I did want to start here. All right, that was terrible. So what we're going to do is I'm going to call it an investor reality check. I'm going to start with that real quick, and then we're going to go through the economy, then we're going to go through the market, then I'm going to go through the questions that everyone submitted, and then I'm going to open the floor to questions. So that's the format this morning. Risk and volatility. Is the market economy the greatest risk to investors' portfolios? Or are investors the greatest risk to investors' portfolios? I always say this one, probabilities versus possibilities. Anything's possible. You don't want us betting your money on every possibility. You want us to look at probabilities. Probabilities are better than possibilities when it comes to risk and return, and so I just let you know that, again, what is possible? Anything is possible. It's usually the thing that we didn't think about that really gets us anyway, right? So I just mentioned that at the beginning, and you can see all the stuff up there from inflation to China to oil prices to COVID to you name it, it's up there. Volatility, right? So I'm going to go through three measurements of volatility, and again, this is just a recap. Market pullback is 5% or more. The market gets 3 of those a year. A market correction is 10%. We get 1 of those every year and a half. And then a market crash is defined by a drop of 20% or more, and we get 1 of those every 6.25 years. So, with that said, this is a market crash. So we are in a market crash, just to give you an idea of that. This one's busy. Sorry, I'm going to try to just kind of highlight some things. Down on the bottom, you can see this. The left are the crashes and the right are the pullbacks. The average S&P drop in a crash is 42%. A pullback is 20%. So we reached 20% in 5% pullbacks on average. But this big drop right here of 42% is what there's a question on that, I'll talk about it later, but what could be the bottom? Is average the bottom? I don't know, but I'll talk about where we've been. And then the other side of this is when you talk about market duration of the crash, a crash on average is 557 days. So, a year and a half to 2 years, somewhere in that range, whereas a pullback is 136 days. So now don't forget, we're already pretty much 11 months into this, and so we'll talk about duration as well too. If we have a crash, we're 2.25% more likely to coincide with a recession. And I'm going to talk about that in a second as well, too. 83% likely to have a recession when we have a 20% or more crash. This one, S&P 500 and panic attacks. So there's always someone's panic attack. I don't know which one is going to hit your panic button. But something does. And so the things that are up here, and this is only in the last 5 years, by the way. This isn't a big, long chart. Trump impeachment, scare, North Korea crisis, trade war, Fed communication error, tariffs, trade war escalates, China COVID shutdown, all the COVID stuff, potential second wave, pandemic goes global, U.S. election, rising rates, Omicron, Russia invades Ukraine, Fed's hawkish comments yesterday, right? So, again, there's always a reason that we're going to have to justify panicking. And I'll just mention, when we think about that, this goes back to that question of whether the market or the investor is the biggest risk. So, if you were timing the market successfully and got out 10 months prior to the market peak, and bought back in 10 months after the trough, you were worse off than someone who just stayed put. So you saw it coming. You got out. And then you got back in. but you still didn't make as much money as a person who did nothing. What about the best days? And this is always one that I've seen it many times through the markets, but just to give you an idea, investors who missed the 10 best days in a given decade would have seen 70% lower returns. So sometimes we find a bottom when the news is the worst. And when that news happens, if you miss those first 4 days that the market recovers, the news is still terrible. They're still talking about the bottom of the market 3 days later when the market's up 12%. You'll never make that 12% up again if that was the market bottom. So again, we don't want to try to miss out on days. We don't want to try to miss out on different things, because more than likely we're going to miss out on the ones that really make the money back. And again, this is pretty self-explanatory, but you haven't lost money until you sell, right? Likewise, we all feel wealthy when our share values are up. You haven't made any money until you sell either, right? So how do you turn that into the dollars you spend is important. But in the long run, the stock market is in a perpetual upswing with temporary declines. And so maybe this time's different. It's the end of the world. If that's the case, my last presentation, I've enjoyed getting to know you guys. We got other problems at that point. And this one, I love this chart. By the way, you'll see this again later in the presentation. But there's been 25 negative years and 71 positive years. So negative years are expected. And when you look here, this is 0 to 10, 0 to 10. So right here in the middle is 0. 0 to 10, 10 to 20, greater than 20% years. Here is less than 20% years. 2008, 2002, 74, and then these three, 50% of those bad years were all during the Great Depression in the 30s. These, a little bit scattered, but there's 02 and 01, 2000, 01, 02. A lot of you were clients of ours during that period of time. So it's interesting to see that chart. Of course, you look here, that sure outweighs those, right? Now, I'm not going to be naive in knowing that if you lose 50%, you have to make up 100%. So there's also a reason why this is skewed this way. But it does work, and it has forever. So that's kind of a little bit of just a reality check of where we are again. Make sure everybody, we still believe in being long-term investors. So I want to mention that to start off with. Are we in a recession? So this is John's chart from April. So this chart shows September, December, those are quarters, and this is March 31st. These are 12 variables that have historically foreshadowed a recession. So if you came to that presentation, you heard this. Things up here based on the consumer, this is based on businesses, and this is based on financial markets. And so when we look at that, in March of this year, we had one red, which was wage growth. Why? Because wage growth was going up, which is a negative sign for recessions. So not what we would think of if we were trying to buy something. And certainly we all brag about our kids and grandkids when they get a new job and a nice pay increase or anything like that as well too. We don't complain about that personally, but it's actually a sign that a recession may be coming. And the other one was the money supply. So we only had one caution and one recessionary sign back in March. What about now? Well, this is July, August, September, and you can see we had five green, and now we're down to 3 green at the end of September. So the trend is certainly going in a direction of a recession. You could just visually see that. But the deterioration of a lot of areas is what's happened. Some of these counterintuitive, right? Like I mentioned, wage growth. Commodity pricing going up is a bad thing. So there's other stuff in here that happens. The yield curve has been pretty flat, but we do know it inverted. We mentioned that in John's presentation. That's still cautionary. Profit margins have started to deteriorate from expansion to caution. So where are we going? Well, if this is the trend, here are the past recessions. Here was 2020, this second one. 2020 was COVID. There are 1, 2, 3, 4, 5, 6, 7 expansion indicators, but we went into recession. We went into that because there was a lockdown. So what was very odd is that all the signs were that we were in the middle of an expansion when that hit. That was a different view than probably anything that we had seen before. But there's everything from 69.70, 73.75, oil embargo, 80, 81 to 82, 90, 91, 2001, the Great Recession. Where are we here? Well, we look better than almost all of them, but we don't look very good. So I would tell you that we are going to be in a recession. When? Not sure. Indicators tell us within the next 4 months. So if that continues on that trend, so basically sometime probably first quarter, we will start to see this quarter, and we'll see if that pans out or not. There's certainly no crystal ball that's going to tell us that, but historical declines in leading indicators lasting more than several months have foreshadowed downturns. Leading economic indicators have been declining for the last 6 months. All things point towards a recession. That's not a surprise. They talk about it all day in the news. I would indicate this, though. This is the recession of 1990 after a very long, successful run in the economy. Right? Basically an 8-year run. And so this was the recession that came. Well, you watch, this was, these are quarters. So 6 months, so second quarter of 90. And so this goes this way. 88, 88, 89, 89, 90 when we were finally in the recession. The market, this is the S&P 500. So the market went up through those 2-year period before the market corrected, even though it took until we get into recession. This time, market's down and we're not in a recession yet. So it's a little bit different, but just to give you an idea, there's a progression where the markets and the economy don't necessarily move hand in hand, and that's the point of this slide. What is going on that's causing it? Well, I think we all know inflation, right? So that's forcing the Fed to raise rates. This 0 to 100, 100 to 200, 200 to 300, 300 to 400, 400 to 500. This is the estimates of how much the Fed will raise rates. Start of the year, not even 1 full percent. By the end of the first quarter, we were going to get between 200 and 300% increases, 2 to 3% on the rate. Where we are at the end of September, they expect there to be between 4 and 5% increases in the Fed funds rate this year. So the only one that's higher than that was 1980. Here's 88, 72, 94, 58, 04. All the rate increases that you see, there's only been one that's been higher than this, which was 1980. Coming into 2022, inflation was expected to moderate, partially due to unforeseen events, including the war. Inflation is likely to stick around longer. Of course, I'm going to talk about some of the other inflationary areas. We'll talk about supply, money supply, things like that. Now, here's an interesting thing I added on the bottom. The Fed really wants 2 things to happen. They want us to be at full employment, and they want to keep inflation low. We're at full employment, and we have been. So what do you think they're focused on? Inflation. That's the only thing they can focus on. So with that said, people wonder what they're doing. They told you what they're doing. They're going to keep doing what they say they're doing. They're fighting inflation, and we have inflation. So it is not transitory. I thought it would be transitory. Right? I think everybody thought it would be transitory because we thought it was supply chain driven, but that wasn't the only cause. So what I would mention about transitory, it's just like real inflation, but it's actually full of lies because there's no such thing in this time and age, right? There is no transitory inflation. So what we thought it was going to be is temporary, and it hasn't been. I love this chart. If you've been in recently, you've seen this chart. So this is the chart from 54 till now, and this is the Fed funds rate. If you can see these, there's little gray bars along the way, typically right around the peaks of the interest rate hikes. In fact, 10 out of 13 of them have those gray bars. What are those gray bars? Recessions. So here's what I think. I think the Fed doesn't necessarily care about raising rates to fight inflation. At some point, to fight inflation. At some point, they want the recession to fight inflation. So the Fed raises rates and pushes us into a recession, and then the recession fixes inflation. Now, we could say that maybe the Fed is going to do a soft landing, and I'm going to talk about that. But there haven't been very many of them. There's only been really 3, and I'll talk about those in a second. But it's an interesting way to think about that. Now, what happened in some of these periods of time? So here, this is the 80s, the early 80s, that everybody wants to remind me about their mortgage rates. No one reminds me of the 30-year bond they bought then. They just remind me that they paid a lot in mortgage. But then they also tell me how cheap their house was, so it wasn't too bad. Right? What happened after that? We had the greatest economic and market expansion in the history of the United States in the 80s and 90s. And by the way, those rates that we all talk about right now, that looks pretty temporary too, doesn't it? And just visually. And what I don't have to cross-lay, but we'll see it, is what did the market do during those years? The market was negative in 1981. It was positive in 80 and positive in 82. And it was only down about, I think, 5% in 1981. So why are we so scared of inflation this time when inflation didn't cause the market to crash last time? So we'll explore that a little bit more. So here are those 3 times that the Fed maybe successfully had a soft landing. So what it is that they've raised rates, and then they're able to cut rates back down without pushing us into a recession. So that's the idea of a soft landing, is that we don't know where we're going because everything we look at is backwards. As an economist, right, is guessing where we're going. So the Fed raises rates. We say, oh, we think we got it, so we're going to turn the corner. We're going to start cutting rates to get us back to equilibrium. Because we know we're going to go overshoot it because the data that we're looking at is back data. So what happens is 3 times they have successfully cut rates back down and found an equilibrium that lasted a little while. Well, 2 of those were in the 80s and the 90s. And I would just mention in the 80s and 90s, there's a lot of reasons. First of all, we know that the markets were good. Inflation came down. Interest rates gradually went down. Why did all that happen? Well, there's a lot of things that could have happened. Innovation, productivity increases, argue technological increases or improvements were really starting then, have continued to this day. The labor force, a lot of different reasons. Population growth, boomers hitting their working years. There's a lot of reasons that could have been the case. But what I mentioned in there, on those soft landings, when we look at it, where were they and when did they pivot? With a tight labor market today, it was similar to that 1966 market. The Fed is likely wary of pivoting too early, which would give way to a re-acceleration of inflation. In other words, with the really nice labor market, they're probably going to raise rates until they see that deteriorate. So we need inflation to go down. We need unemployment to go up. So has there been a presidential election in the last 4 cycles that didn't talk about jobs, jobs, jobs? Both sides. Everybody wants jobs. Everybody wants jobs but the Fed. Fed wants less jobs. So it's very odd. It's interesting times. But the labor market, really, that one was tight in 66. There was excess in 84, and there was slack in 95 in the labor markets. But all of these, when you think about it, 84 was coming back, the excess, the creation of jobs and things like that. It was a good time in the economies, but 66 was not as a great time going in. So think about that. That was the only one that had an overall recession signal as well, too. CPI was 3.8. 3 years later is 6.2. The other 2 is flat. So it still went up in inflation during the 60s, but then you think about what happened after that. Then we got into 73, 74 was the oil embargo and some things like that. A lot of reasons. If you type in why did we have inflation in the 70s and 80s, you'll find everything from that we weren't finished with the gold standard. We still had the Bretton Woods dynamic. We had a lot of different things. We had the emergence of women entering the workforce by droves. And so we had a giant increase in the amount of our population that was working. So just a lot of different reasons. And every time it's going to be a little different. Back to this again, kind of thinking about it, what were the rates in here? So someone asked this question, what if we have longer, higher inflation? And I would just say the 80s and 90s, we averaged about 5%. I think it's sustainable. I don't think 8% is. I don't think where we are is today. But we can certainly ride at 4 to 5% as long as we can match that. Now here's the problem, is that I would argue one of the reasons we had the inflation back then is because when you have higher prices, people pay their employees more, which means higher wages, and then higher wages cause there to be more money in the pockets of the people, and they buy more stuff, so then you got higher prices equal higher wages equal higher prices, right? And so that cycle is what causes bad inflation. And certainly coming after COVID, you're seeing that. So, I mean, you heard us, right? I started this meeting with hiring 2 people. So here's inflation. Well, what's interesting about this inflation, this is from the 1800s till now. So what was going on? This is zero line right down the middle. Anything below that was deflation, which is much worse for the economy. We want inflation. We don't want deflation. Well, what happened? Well, we look in the 30s, is when we left the gold standard. Roosevelt followed England, and then we actually had deflation as we made that transition, but after that, we became a lot more stable. So I would argue that the Federal Reserve is part of the reason that it has stabilized. Now, this is from basically after World War II. There's the 80s. Here's where we are now. So here, 81. There hasn't been anything in 41 years that high. So that's what you're hearing on the news. That's what we talk about. It's like, wow, that is something different, right? Certainly different for most of us in the room. I'm guessing in 1981, there weren't many people in here that had been retired already. So what's driving inflation? So this chart is pretty interesting. People, what are the components? So we started as a story of excess goods inflation, and it's brought into a story of excess everything inflation. And so when we look at these, and this is from 18, then COVID, and then this is since COVID, what you see is the dark line on the bottom is OER, and that is core services excluding housing. The gray one is services ex OER, and then these two, which are pretty much added on, the burgundy, I guess I'll call that, is goods minus used cars, and the light blue is used cars. So you start looking at that, and that's what's stacking up. But what you've seen here is now you're watching used cars drop back down a little. You're still seeing goods, but your services have increased theirs as well, too. So everything's causing inflation right now. Supply chain has always been one that people have been talking about. Well, supply chain has dropped drastically as far as backlogs. So we are starting to see that open up. So supply chain is not the excuse anymore. When people talk about it, the pressure of that has dropped. Now, is it back to zero? No. Is it still elevated? Yes. So there's still some pressure, but it's not the only answer anymore. Consumer outlook, dependent on wages. Consumption is closely tied to changes in income, both of which have been higher than inflation. So you're seeing wages go up, which didn't go up for 20-something years. We're finally seeing wages go up, but we're also seeing consumption go back up. And then on top of that, people don't feel like long-term inflation is a concern. So we have this assumption that this is going to be short-term inflation. With that said, it's like, well, it's going to be bad, but it's only going to be bad for a while, and then it's going to get better. So that doesn't normally prevent people from spending. And I heard this at something I went to recently. I think it was one of the UNCW economists. And he made the comment, he called it revenge spending, which is a great term. It basically said, I didn't get to spend any money the last couple of years because of COVID, so I'm going to go out and spend like crazy. What's really funny is consumer confidence is in the toilet, but we're still spending money like crazy. Right? I feel really bad. I'm going to go spend money to make myself feel better. And I really feel bad because I don't have any money to spend, right? That's the idea, but it's not working that way. So again, kind of thinking through this again, as we think about the Fed rates and the Fed causing inflation, fighting inflation with recessions, I would tell you we're going into recession. And then I wanted to just give you an idea here. When we think about the average inflation rates, that's what we saw. That in the middle was the 70s and 80s. That's the 90s. So we went from the 70s going up. This is the average of the decade, 7.25. But then the 80s were 5.82 and the 90s were 3. So we actually averaged somewhere around 5% throughout those 2 decades. Now, what have we done since then? Very little. So we haven't had really any tough inflation. 20s, we didn't have any inflation because we were dealing with deflation. Labor force participation. Why aren't people working? Right? That's what the story is. Well, this is since 1950. You see this peak throughout here, which were the 80s and the 90s. That was that peak there. And then it's dropped back off. I don't know. I don't think anybody knows. But we're at 62, which is up about 2% since the bottom of COVID. And that's 2% of, right now, there are 208 million people in the United States that are 16 and over, 16 to 64. I guess apparently when you get 65, they don't count you as in the workforce anymore, even if you're working. So there's 333 million people, and there's 208 million in those working years, which comes out to, and this is just silly, but comes out to 62.4. And there's 62.3% of those 208 million working. I guess they're just keeping with the statistics. I don't know. But this is an interesting one because people say, well, why aren't we getting more people back? Before we went into COVID, we still weren't even at 63. So we're getting back to what we were used to for a while. So people are re-entering. What's the Fed telling us? Well, Fed's telling us that they want to see unemployment go up, and they're going to keep raising rates until they do. So they are telling us that we will likely see a 0.7% increase in unemployment. So that 62.3 was labor participation. What we're talking about now is unemployment rate. So we bottomed out, and that's moving over the other way. Home Builders Survey, this is a weird one, but if you flip over the relationship between the housing market and unemployment, that's also an indicator. And what that's telling us is that the housing market's starting to go downhill, and that's a leading indicator of unemployment going up. So that's starting to happen. And then, will we bend or break in the housing market? So just to switch gears onto that one, you've got year-to-date increases in mortgage payments for new home purchases, 60% increase for the same price house this year because of mortgage rates. So houses are becoming harder to buy, but we are still constrained with a low inventory. If you need a house, you might just have to pay more for it, or prices may start to go down. We're starting to see that already. Crisis of confidence, small business optimism, CEO optimism, both of those have dropped drastically recently. So I think the idea that businesses are not comfortable because of what the Fed's doing, it shouldn't be a surprise because the Fed's told us what they're going to do. But what it does is it might impact future hiring decisions. It might let them not spend as much money, which, by the way, causes recessions, which is what the Fed wants to get us out of inflation. So again, bad news is good news. Consumers, though, this is household leverage or debt. Debt has dropped drastically over the last 20 years as a percent of the household balance sheet, which this is a good sign. Now, it popped up a little bit in the last year. After COVID, it's come up a little bit, probably because interest rates went back down to zero and housing market went up, so mortgage amounts jumped. But overall, we're in pretty good shape as consumers from a household balance sheet. Margin for error, this is talking about margins, and basically we're looking at profit margins of U.S. companies. And typically, when profit margins peak, a recession's coming as well too. So don't know exactly where we are here. That could have been a peak there. It's what a lot of people are wondering. If there's starting to be pressure on this, we're going to see profit margins drop. And then this is that unemployment curve. So unemployment started coming up in April and May, June, and in July it peaked and started actually going back down. So the labor market has tightened the last 3 months. Now that might change this month, but the Fed's raising rates and unemployment's actually working against what they want. So another reason why the Fed made its announcement yesterday, we might, and this is what they said yesterday, we might slow down, we might decrease the size of our rate increases, but we're still going to do it maybe for longer. And so that was why the market, by the way, jumped 300 points and then went down 300 points between the time the rate announcement and when they spoke about the rate announcement. Here's an interesting one. It says, how long will it take? So that's a question people have. How long will it take for us to get back down to this target that they want? Well, this inflation to get here, I would tell you almost at a minimum is May of next year, probably likely August of next year. So we have a long way to go before inflation gets to a 2% target. I don't think that that is necessary. The Fed may change their mind about that, but they've mentioned a 2% target. So it would be likely at fastest, unless some drastic thing happens, May of next year, but likely the end of the summer of next year. So expect there to be decreasing but higher inflation. So that's the economic stuff. Let me do some market dissecting for a second. So this is the S&P in post-war recessions. So during the recession, someone asked the question, what's the drop during recession? So, and we actually got a little bit worse than this because this data is from the end of the month of September. But this is where we are this year. So all the rest are during recessions. If we're going to be or are in a recession, this is where we fall historically. So that was a 25.25% drop in the market through September. It's actually got a little worse than that. The average recessionary sell-off has been 30%. So again, I've talked about earlier the sell-off of a market crash. This is a recession sell-off. So two different ways to look at it. So 29.9 or 42, depending on which average you want to pick. So is it the market or is it the economy? One of those. This is the economic view of it. The market view of it would be 42. So somewhere between 30 and 42% drop would indicate that we have reached peak drop average. I don't know what that means for anybody. Realistically, we don't know if this time is going to be different. So if you're waiting for average and you're going to bet on average, you're probably going to get it wrong. So I wouldn't say when it hits 42%, it's a buying point. Right? So when it drops 30%, it's a buying point. Because that's averages. On this side, it's an average of all of these recessions. So where are we? Well, year to date, and this is as of last night's close, I did these this morning, down 22% on the S&P, 33% on the NASDAQ, 11.5% in the Dow, 16.5% in the bond market, which I'm going to talk in more detail out, and Bitcoin's down 57.5%. There's a couple questions about digital currencies and stuff, so I threw that in there. What was the lowest point year to date? So the market was down 27, and that happened on October 13th. Oh, look, NASDAQ, Dow, all the stock indicators were all reached a bottom on October 13th. Down 27 for the NASDAQ, 36 for the Dow, 21. For the bond index, it was a week later, it was down 18%. Bitcoin was down a little earlier, 61% for the year. So I wanted people to understand that when I think about those prior times, what we've seen in the last, well, really, historically, except for before most of us, certainly before I was born, when most of us were born, this bond market is different. Stock market, almost everybody in here has been through those before. A 21% market drop or even a 30% market drop, we've been through a few of those. COVID 2 years ago was a 33% drop in the equity markets. But this bond indicator is what's different. Someone asked about a 60-40 portfolio, which a lot of moderate retirees have, and I'm going to talk about that in the questions in a bit. But the bond market, this is what I was going to show. So this is since 1980, and that's the bond market that we have this year. And this is the bond market since 1980. In 1980 and 81, the bond market was positive. So when people talk about peak inflation, those were actually positive years. So what were the years? Well, the years were in 99, and the years were in 2014, I think it was, 13. And by the way, the stock market was up 37% or something in 13, so we didn't even notice our bonds. All right, but this is different. So let me give you a perspective on what's going on in the bond market. So the concept is, I've bought a bond. Let's say I bought a bond at the beginning of the year, and I put $1,000 into a 10-year treasury, and it was paying 1%. Right now, a 1-year treasury is paying 4.5%. So I want to sell my $1,000 treasury. Who wants to buy it? I'm paying 1%. You can take your $1,000 and go get one at 4.5%. Does anybody want mine? Nobody wants mine with their $1,000, but would you give me some money for it? Would you give me $100 for it? Would you give me $200 for it? What would you give me, right? And so that's the market price based on interest rates. Did I mention that we're talking about treasuries, which are 100% backed by the U.S. government, the highest credit quality there is? There's no difference in those bonds. So it's not like I'm buying American Airlines versus Johnson & Johnson or worrying about the corporate side. I'm just talking about 100% guaranteed U.S. government debt. Well, if you bought one at the beginning of the year that was 1 to 3 year maturity, you're down 5% this year. And if you bought one that was 3 to 7 year maturity, you're down 12, 13% this year. So government guaranteed down. So what's everybody asking us right now? What do you think everybody's asking? Hey, I heard about these T-bills. Heard about these T-bills. Yeah, we are. We're getting 4.5% for 1 year. Well, shouldn't I get out of my investments and buy that? Sure, let's sell your bonds that are down and buy other bonds and realize that loss. No, we should wait. We should take those to maturity. When those bonds mature, then you reinvest those. And that's what we hope to do in the bonds. So it's a different animal, but we're seeing every single bond fund that we have in clients' portfolios, rates are going up. So we're getting more payouts, more payouts, more payouts. Money markets are paying more. You know, our bond funds are paying more. Everything's paying more, and it's been a very quick increase. So one of the good things about a bad bond market is that we're all going to get paid more as conservative investors. So one of the interesting things, if you've got the stock portfolios down, you got the bond portfolios down, it feels worse for a moderate investor because both sides are down of the balance sheet. Now, someone asked about the 60-40, isn't it dead? It's the worst time it's ever happened. I would say probably it's the worst time it's ever happened, and next year might be the best time you've ever owned the 60-40. Because if we do get in a recession, what has the Fed done every time? They've cut rates. And so it's going to push those bond values back up while hopefully the equities also recover as well too. So I wouldn't sell into the worst market that's already happened. I'd be thinking about buying into the lowest point of those investments. And we joked about this with one of our investment meetings this week. One of our managers said, there's a lot less risk in my portfolio now that it's down. Right? Well, what does that mean? It's like, well, yeah, there's less money at risk because you lost us money. That's another way of saying that. But he thinks about it this way, and this is where I would get you to think about it. I own really good companies, and all those companies are cheaper right now. They're already down. Doesn't that make them safer investments? And so that's his perspective, which is, seems pretty obvious. He loves the companies he owns, and he believes in them long term. So why sell them when they're cheap? It's a different way of thinking about it. Here's a breakdown of where we are. This is 1 year, and this is 5 years. 1 year, growth, growth, growth. Really beaten up. Value's done well. Over 5 years, though, growth is where you made all your money and value you didn't. Why this shift? Valuation changes. Here's all your tech stocks. A lot of the things that led the market are the ones that have gotten hurt the worst. And so if I said, it was great that you bought Amazon 10 years ago, it's having its one negative year in 10 years. Do you want to sell it? Or do you want to buy more? Right? So what we're seeing is some of the leading things in the economy actually taking the biggest hit. Well, it also makes sense if they had the biggest run for the last 10 years, that would be the area that pulled back the most. And by the way, they're still the best 3 and 5 year returns. Cart before the horse, so this is just saying, are we done? So what's the length of the recession? And again, if you go back, 10.3 average on a recession, so I don't know how long this next recession will be. But then what happens with the market drop during that point in time? And it usually comes during the recession. So we might not be at the bottom yet if we're not fully in a recession yet. And so when we do hit the recession, when do we see it turn around? And I would argue that the bad news is going to be good news. When the Fed stops raising rates, when unemployment goes up, when we start seeing some bad stuff, we're going to see the market try to guess that it's time to turn around. Counter trends, and again, this talks about this as well. Opposite things usually happen, but counter trends are basically what we would call head fakes in the stock market. Right, we see the market go up, but we're still in a big decline. Is that what just happened? Last 3 weeks, since the 13th, we had a market recovery. Are we in a head fake, or is that the actual bottom? We don't know. But it's something that's very common, so we don't say, oh, this time it's the bottom. We won't really know the bottom until we look back quite a few months later, not days. Investor sentiment. So the two that are highlighted are where the market is today. So you've got 43%, which is the bear indicator, so basically not surprising, but when the average investor is really negative, it's usually a good sign for the economy, for the markets. So when you start feeling the worst, it's when you should think about adding money to the portfolio. That's another way of saying that. PE ratios, people ask about the price, and there's a lot of different ways to calculate it, but we are getting back to close to good prices. And so when we look at this, at bear market bottoms, this is what the PEs were. And this is 66, 70, 74, 82, 87, all through the 60s, 70s, 80s, and 2000s. So in 2009, where were we at the very bottom of the market, adjusted for earnings, and that's where we are today. So we're getting close. We're actually, PE is cheaper than where we were in COVID recession, not surprised, but also 2002. Stocks are cheaper now than they were in 2002. What's the path for earnings? So earnings revisions have declined 26% on average across the last recessions. We haven't seen that yet. It's not uncommon for earnings estimates to bottom out after the market's lows have already been hit. So I would expect earnings to be dropping, but it doesn't necessarily mean that the market's going to react exactly to those. Revisions during the global financial crisis, for example, so the markets bottomed in March of 2009, and the earnings bottomed in May of 2009. That's what I'm talking about right there. It's 2 months after the market bottom that earnings hit its worst spot. Paradigm shift. This was the average for 15 years. Mid-cap and small-cap values. These were the worst performers, and of course the recent one, it's been totally different, so that's what I mentioned earlier, growth versus value. Dividend growers have been dominating this cycle, so people who pay dividends. A lot of reasons why, I'm not going to go too much into it. Presidential cycle tailwind, usually this is a good time if you want to base it on political stuff. It usually is a good time to invest in a presidential cycle. I don't think you should do that, by the way, but people want to always talk about politics, so I want to throw it in there. It doesn't matter which party. Bear market achieved, is it a good entry point? And so this is a tough one as well, too, but once a bear market has occurred, markets typically continue to sell off with recessions experiencing larger drawdowns. However, if you stay the course after the 20% decline, even with recessions, 12 or 6 months later is negative, but even 12 months later, positive returns. So positive returns even after those big, terrible ones where the market and the recession hits. 5 things that are kind of on our radar: midterm elections, certainly, inflation, the market leadership or the rotation in the sectors, volatility to international. I'm not going to talk about all of these. Did want to highlight international. So this is a long-term discussion, but blue is when U.S. outperformed, and the black lines are when international. And so you see this, and we have been outperforming the rest of the world for a very long time, since basically the Great Recession, 2007. When will that change again? Because when it changes, it happens a long period of time. This was almost 100% outperformance. That was a 400% outperformance. Someday international will get more attractive. Global valuations are cheaper, so international stocks are cheaper than U.S. stocks. When the dollar weakens, international stocks look even better. We've been hitting all-time highs for the dollar. So there's some things that are starting to point to international, but man, is it a scary place to invest. Again, volatility does not equal financial loss unless you sell. Market annual returns, again, that chart, keep that in mind. I'm going to run through these questions. Most of them, not most of them, some of them I hit. Historic average length of the U.S. recession, so that's been in there. When can we expect a recovery from the latest blast from the market? And so I think you heard me say, I don't know. That's a tough one. I do like to see when 3 of our indicators all bottomed out on the same day. That's a good sign. If you want to get into technical stuff, that's a little weird. I would tell you that there's support levels or something that we talk about in the market from a technical traders. So day traders, kind of think of it that way. Day traders, there are support levels, and they are always being rebuilt. And the way we see those is because there are options that buy and sell. There are market orders in there, so market makers can see all the orders that are sitting out there. So they can see that at this price point, they call it a support level, there are a ton of buy orders just floating out there. So when the market hits that, it's like, wow, everybody's going to start buying at that point in time. There are also resistance levels or ceilings when those hit. What's going on right now is that there was 3,600 was a level, and that seemed to be close to where we hit the bottom. There is a support level, 32, 33. That means we'd have another 14% drop from here, which is not fun. It doesn't say that it couldn't turn around the next day, but it does put it back into some of those historical averages. There's a talk of a new inflation reality, perhaps around 4%. How will this market receive this shift? Right now, I would say the market is terribly scared of it, and so if we get there and stabilize, the market's going to like it. I think that's going to be the counter. If we get to 4%, then the market's going to be just fine. They just want to see us get away from 6, 7, 8%. So I'm not too scared of that. I hope that wages, prices cycle doesn't continue. So I kind of am in favor of what the Fed's doing to see unemployment go up. How are today's higher interest rates and prospects for further increases affecting portfolios? So it's interesting, but this is where I talk about our bond funds really starting to pay out more. So what happens is if you're in a 60-40, and this was 5 years ago, we're getting 2% on our bonds. And hopefully next year we're going to be making 4.5% on our bonds. That's a big increase in as much as producing cash flow that we don't have to sell something to fund our retirees' portfolios. So higher interest rates aren't necessarily a bad thing. Rising interest rates are a pain, but when that stabilizes, we'll see where we go from there. And so if you are making more on your fixed income investments, then that's good for producing cash flow for people who are taking draws off their portfolio. That's not necessarily a bad thing. It's the pace and how to get there that's the painful part. Should we be putting more money into I-bonds, inflation-protected bonds? Just a couple things, because this question was also down here. What do you think about gold and silver? So a couple things on those. So one, gold has been down, but down less this year. Gold's probably been a better safe haven than I-bonds, inflation-protected bonds. I think the concept of inflation-protected bonds has run its course. So if you were going to get into those and hope for it, you had to jump in it really quick because everybody priced them up really fast anticipating this, and it's not really producing it. And so there is I think people have seen the TIP or I-bills or whatever it is you can buy from the Treasury. They're like $10,000. They were paying, big news item, 9.7%. Now those are down to 6-point-something%. Those will, but that's only 10 grand, so it's not a lot to do with that. If you have new cash, you match your portfolio, you put it in your portfolio will do better than locking it up in 4% treasuries, in my opinion, over the next 3 years. I would not want to lock your money up for 3 years at 4.5% when I think your portfolio, well, we've seen it from October 13th until you got your statement, portfolios went up more than you could lock in for 2 years. That's why you don't try to time the market. If you have a 529 who will be attending college in the next 2 to 4 years, and that account is on one of the autopilot programs where they adjust, should you put in a static investment more heavily weighted towards equities in order to make up some of the ground? This is a risk question. Do you want to put it more into equities, your grandkids' college, your kids' college, in order to try to make up some of the difference? And if you've got the means to fund it elsewhere, probably wouldn't hurt. Probably a good opportunity if you can wait 2 to 3 years. If you need it in 6 months, probably not. But if you need it in 2 to 3 years, that's a way that you could try to take advantage of it. What's the biggest threat to the stock market over the next 6 to 12 months? There's a lot of bigger issues that I don't know that this question's trying to grab, but like, for example, if China attacks Taiwan and takes over Taiwan, we have a semiconductor issue that's going to go across the world. We're going to go back into supply chain issues and all this crazy stuff. If we decide to fight North Korea and Russia at the same time, so there's big issue stuff that would definitely hurt the market. I don't know that this is, when I think about the direct impact on economics and market behavior, one of the things that I think is this inflation. And if the Fed's rate increases don't cause this, then I think we are in trouble. And there's a lot of excess money out there. What constructive short-term strategies could be used to ameliorate expected further short-term losses? And if you don't know what ameliorate means, I haven't heard that word in a while. That was a good word, whoever sent that question in. That means make a bad thing a little bit better. And so what I would say is, I love the part is, if you missed it, it said the expected further short-term losses. So my issue with this question is that word. That if you expect more short-term losses, then you can make some decisions. But I don't expect short-term losses. And so there's going to be daily losses, but it could be after a 3% run-up that we get a 1% drop. It could be a 7% run-up and a 4% drop. So the timing of that is too difficult, and you will screw yourself up and make worse decisions by trying to do that and shift strategies when things are already bad. Are firms still recommending the 60-40, given that it has the worst performance in 100 years? Answer is yes. Probably the best time to buy a 60-40 that we'll see in another 100 years. I'm most interested in Pathfinder's investment strategies going forward. So I want to talk about this on a high level. Some things that are very important to us are taxes. So if you're in a passive account, which is an after-tax account, we are using indexes. And the reason we do that is because to pick ABC investment or ABC mutual fund versus XYZ, what you're going to run into is a loss of 30% in taxes from moving from investment A to investment B. Was investment A going to give us 30% more than investment B? And if it doesn't give us more than 30%, then it wasn't worth the taxes that we have to pay to make the shift. So again, I think in after-tax accounts, being passive is a great strategy. In your IRAs, we can be more active. And the reason why is because we don't have to worry about taxes. So in those areas, we can add active management and things like that. With that said, we are still going to believe in diversification. This year, Exxon's up 90% or something. Would you have wanted us to load up your portfolios 100% in Exxon on January 1? That's a trick question. The answer is yes. Right? But do you want to be there right now? Because that was looking backwards. But do you want to put 100% of your money in Exxon now? And that's a harder question, right? So the idea is if we diversify, then we don't have to worry about that. And that's the boring, tried and true method of creating wealth. And so, yes, there are the one or two stories where people got wealthy off of individual stocks. Most of those started with the company when there were 4 people in it. There are a few, but I would tell you that people have done just fine with the S&P 500 or very similar strategies in the long run. During the roughly last 15 years, new industries were created. How have you been adapting our portfolios in view of these changes? So I love this question. There's a million different industries that are out there. There are the ones that have been really trendy, like the cannabis industry, water technology, 3D printing. So these hot ones, right? Digital currency has been one of those recently. So these are industries that are being created that are new industries. Electric vehicles, all the different stuff that's out there. If you participate in an index fund, again, I'm going to be boring here, the S&P 500, Tesla is in the top 10 stocks. You would have had to buy Tesla on hopes and dreams and negative cash flow. This company is losing money hand over fist, run by a crazy guy. I'm going to take a bet on that. But you could have bought the S&P 500 and it could have been a top 10% of your or top 10 holding in your portfolio. Why is that? Because the way that the market works, if stocks are successful, they start moving into the indexes. So Tesla moved into the industry when it was 505th in the S&P 500. And now that it's top 10, you participated in that upcycle. So you do not have to pick a industry or a sector, because once you do that, then you have to go in there and guess which stock in that sector is going to work. And there was a lot of other companies, that, particularly electric vehicle, if we want to talk about that one, that aren't in the top. So again, there's short-term trading, that's a different story, and then there's investing. So we do participate in all the best strategies in the long run. How do our selected funds in the portfolio compare to our benchmarks? We've done, actually doesn't feel that way, but we've done really well this year in our picks. So we've got an outstanding large value fund. We talked yesterday about our international. It's like a sore spot. It's down 26%. The index is down 25%. This guy normally hits the ball out of the park when it turns around. Do we leave him now because he's down 1% versus the index? Because that could happen. That could be changing right now. He could be beating the index by the time the day closes. So again, thinking about that, that's one that, it's harder to do that. We've got one of the top 10 small cap funds. We've got one of the top 10 large value funds. Some of our bond funds, depends on where they are. Some of them were hurt a little bit more than others. We've got some top performers there, but we had, for example, one of our bond funds, and again, there's a lot of them, does not take interest rate bets at all. And so they hedge out interest rates. So they've been riding with the index. And so if they took interest rate bets like one of our other funds, they probably could have fared a little bit better, but that's just in their philosophy. We know that going in. So, when it turns around, they're going to participate on the upside drastically too. So, but overall, we've done a pretty good job this year. There's always one or two lemons in the portfolio that we're watching, but those lemons will make lemonade, and then the lemonade will get spilled, and there'll be some more lemons to be had. So. The Einstein and Homer Simpson theory, I think I've said that one before. If you're Einstein this year, you might be Homer Simpson next year, right? So we try to just get up there and hit base hits for all you baseball fans out there. Like, we don't try to swing for the fences. When do you think the bottom is for equities? If not, what's your target for the S&P 500? So I mentioned the bottom. There could be some downside. I do want to share this with you. I have this funny thing that I put in my calendar. I put this in my calendar on Monday, November 7th, 2012. So it's almost exactly 12 years ago. I guess that we would average at least historical averages, and we would be near 3,600 or higher. So that means I thought the S&P would average at least 10% a year. And right now we're above that level. The bottom of this year was around that level. The high was much higher than that. It was 20% higher than where it is. So the S&P 500, if you said 10 years ago, I think it's going to be at least 10% returns. I think that's the way to think about this, is that the bottom could come soon. It could already be in, but when the market's down, it makes the longer-term returns look better. So don't look back 10 years and think that that's the same thing that's going to be in the next 10 years. You've got to assume the correction in there to make a viable case for staying as an investor. Within equities, which sectors are likely to have a better return in a high inflationary environment, and how long do you think inflation will remain elevated? So I don't think inflation is going to remain elevated for years. A year, yes, but it's not as much about a high inflation environment as it is the trend of inflation. So I think the trend will continue, which is on the downside. I don't know how fast that will happen. But high inflationary sectors depend on what's causing the inflation. So, for example, oil and energy has done fantastic, but I wouldn't count on that because a lot of that stemmed from a lot of global issues. We're not in a recession, so prices aren't going to necessarily go down, but when we get into a recession, oil prices tend to go the other way. But there's obviously a battle going on between Russia and Ukraine, and that's causing all kinds of things there. So normally inflation, if it's commodity driven, you buy into the commodity companies. But again, that's a risky proposition as well too. All of the tech stocks, if they can pass their cost on to consumers, will typically be better performers over the full cycle. So if inflation stayed high, if valuations get cheap, they're going to be able to pass their cost on better because they don't carry debt like some of these big companies that carry debt. And so if you look into big manufacturing companies, can they pass that cost on? Well, it depends. If their debt is going up and it's costing them more, they have to, but they're not making more money. So there's things like that when you start dissecting it, value has done better because it pays dividends and there's valuation issues going on. But when that reverses, a lot of the dividend-paying stocks are not the best performing stocks long-term unless they are low debt. And so again, some of that turnaround, you might see a return for the growth stocks over the next 3 to 5 years pretty aggressively. Do you think that we will see interest rates as low as we have seen over the past few years ever again? I'm not going to ever say never, ever say ever, never, all that. What I will say is that I don't expect us to get back to zero for many, many, many years, unless something really bad happens again like a COVID. So I would expect us to have more normalized interest rates, which to me, normalized interest rates are fighting inflation. They want inflation 2 to 3%. Rates should be 3 to 5% at a minimum. So I don't think that we're going to have interest rates back low unless something drastic happens. I think the problem that we saw was everybody was too quick in Congress and the Fed to throw money at everything. And so I think, unfortunately, that might still be the case if something bad happens. But I think the Fed learned its lesson during COVID not to do that. Gold and silver, I mentioned those a little bit. I do think those are promising, but those are short-term promising. And you'd have to count on the dollar dropping, which I wouldn't do that yet because there's nowhere else to go in the world. So I think your international stocks will outperform your gold when that does happen. So even though gold might be promising, it's a temporary issue and not a long-term investment. And then the last two are on crypto and currencies. And until we get a $5 trillion marketplace for digital currencies, it's not going to make it into any mainstream institutional portfolios and things like that. So at this point in time, it is more the technology that's underlying the digital currencies. And 61% drop this year is not something that people normally need in their retiree portfolios. But I would say, like, if you want to gamble a little bit on the side, once it becomes a $5 trillion industry market cap, there might be some room to add it into a portfolio, but we're not there. And in fact, we wiped out half of that this year. So we're further away than we were in January. Those are all the questions. Any other questions? So I covered a lot in there.
What are your thoughts on the military industrial?
That's an interesting one. So if we are providing weapons and other things, military might to places like Ukraine and things like that, as we're doing this, do we need to replenish that as a country? It is usually an area that when we start rebuilding internally, I would tell you this is government spending. So the way that we look at the government is that when government spends money, you get in front of it. And when the government is taking money, you try to get out of the way. And so whether that is, and I'll say it a couple ways, whether that is whoever's in office, someone wants to put money towards next energy stuff, or someone wants to rebuild the military, or someone wants to do infrastructure, whatever that is, when the government spends money, you do want to get in front of that because that is an economic boom. It does cause growth. It does it typically with debt. So that's not necessarily the greatest thing long term, but debt is the way that we've grown this country for 100 years. And so I'm not saying that right now is the time to do that, because that might further exacerbate inflation. So from an economic standpoint, which is the part I'm going to talk about, might not be the best time for the government to spend more money, whatever that is. They've already announced a lot of spending this year that's got to get out there, and we're trying to fight inflation. So the Fed and Congress, fiscal and monetary policy are a little bit ahead right now. In the long run, though, that is an area that the government helps us, just like the other areas I mentioned as well, too, helping prop our economy up. And we just don't need that right now, which is weird to say. Yeah, I can't speak to I'm not going to speak to the other side of that, which is the military and safety and all that stuff. That's a different subject. So, other questions? All right, well, thank you all for being here. Enjoy the rest of your day. Yep.